Hello, I'm Dan Dyer. Do you know you're $217,000 in the hole? For a family of four, it's $868,000 deep. That's the average American's per capita share of the fact that the present value of projected federal government expenditures is about $66 trillion greater than the present value of projected federal revenues. Since 1950, revenues have been a constant 19.5% of gross domestic product, as the top marginal tax rate has varied between 35% and 91%. If you want to increase federal revenue, you have to increase GDP. Looking to the future on this chart, revenues continue flat at 19.5% of GDP, but under present law, expenditures will rise far above that. The weak dollar will get much weaker, the nation will be bankrupt. Already $9 trillion in federal debt is more than 4 years of total federal revenue. We need several major reforms, and we need to prioritize the reforms. Our highest priority reform should be to pass the fair tax in order to grow GDP. There are only 4 things we can tax: assets, which we do with property taxes; transfers of assets, which we do with capital gains, gift taxes, and estate taxes; the creation of assets and wealth with payroll taxes and income taxes; and the consumption of assets and wealth with sales taxes. We all know that when you tax something, you get less of it. When you untax something, you get more of it. 93% of the $2.2 trillion the federal government takes in each year comes from income and payroll taxes. In other words, we tax the efforts that create assets. On the income side, the IRS says it has a tax gap of $345 billion it's owed but can't collect. We each could have paid 32% less. The reason is complexity. The tax code has been amended 16,000 times, about twice a day, since a major reform in 1986, and now has 67,500 pages and 526 forms. Because of this complexity, we spend $265 billion on compliance just to figure out how much we owe. That does not include the value of our personal time keeping tax records and filing. The poor spend a much higher percentage of their income on compliance than the well-to-do. A few years ago, the GAO estimated that the cost of inefficiencies in distorted decisions we make to get the best after-tax results amount to another 2 to 5% of GDP, making these costs as much and perhaps much more than the compliance costs. Money Magazine sent records for a tax return to 47 professional tax preparers. Each one came back different. None of them was correct. In the case of the income tax, the top 1% pays 39%, and the bottom 50% pays 3%. A number of options are being proposed to fix this broken, disgraceful system. One of these is a tax replacement plan. Instead of taxing and discouraging work, the fair tax taxes consumption, which economists say we should do, and increases the incentive to save and invest. The Act, H.R. 25, has 72 co-sponsors in the House, where it's in the Ways and Means Committee. To show its simplicity, the Act has 133 pages. A plain English summary is 36 pages. The fair tax will abolish all federal personal income taxes, corporate income taxes, gift, estate, capital gains, alternative minimum, Social Security taxes, Medicare taxes, and self-employment taxes. It replaces all these with a progressive, national 23% retail sales tax on all new goods and services. The key words here are all, new, and progressive. All means there are no exemptions or deductions. In 2007, the fair tax base would have been $11 trillion, 81% of GDP. That's more than twice the $5 trillion modified taxable income base in the present code because of all the exemptions and exceptions. The new says you won't get double taxed or triple taxed. If you buy something new and decide to sell it right away, you've got a tax receipt, so the item is now used. The second buyer will pay you almost as much as you just paid, and you'll recoup most of the tax you've paid. So the prices of used goods will continue to retain their consistent relationship to the prices of new goods. The progressive is very important because the fair tax is more progressive than the present system. The fair tax untaxes the poor. No one gets taxed for the most essential goods and services. The way this is defined is to use the federal poverty guidelines. Every household receives in advance the taxes they will have to pay for necessities at the poverty level. You and I and Bill Gates and the poorest family in the country with valid Social Security numbers will get in advance a monthly payment of 23% of the poverty level for our family size. This rebate in advance is called a prebate. For a family of 4, the guideline is $27,380 per year. 1/12 of that times 23% is $525, which will be transferred electronically each month to your debit card. $6,297 a year to pay all taxes for the necessities of life defined by this guideline. The prebate goes up for each additional dependent. As a replacement plan, the fair tax raises the same amount of money as the present system. After enacting the fair tax, since there would be no income tax, the plan calls for repealing the 16th Amendment passed 95 years ago to allow an income tax. The tax will be collected locally. The retailer collects the tax and forwards it monthly to the state, as he does now in 45 states that have sales taxes. These 45 states have 97% of the population and the economy. The state forwards the tax to the federal government, and the retailer and the state are both paid 1/4 of 1% of what they collect. The 5 states that have 3% of the population and don't have any sales tax can set up a new sales tax authority or outsource the task or get the federal government to do it. Many states may want to harmonize their sales taxes with the fair tax by adopting a common base to make it easier on merchants and everyone else. If states adopt this broader base, on average they could drop their sales tax rates from 5.4% to 2.2%. States that conform will find it much easier to collect taxes on internet and mail-order retail sales. 42 states have income taxes, and these conform partially to the federal income tax. A good approach for these would be to switch entirely to a sales tax, like Florida and Texas and 6 others. The rationale behind a fair tax is that 20 to 22% of the prices we now pay have to cover some embedded costs of suppliers that will go away. These include payroll taxes, 15.3%, corporate income taxes at a 39% rate, and compliance costs without counting the inefficiency costs mentioned earlier that would also go away. So the fair tax replaces taxes that are embedded, hidden, and complex with taxes that are transparent, open, and simple. Whatever system we use, we know it's the consumer who ultimately pays the taxes. Corporations merely collect them. So payroll tax, corporate income tax, compliance costs, and the cost of some inefficient decisions will come out of business costs and prices. We'll untax U.S. exports and sell more overseas. 500 businesses surveyed by the Princeton Economics Group said that under the fair tax, they would locate their next manufacturing plant or corporate headquarters in the U.S. How big is this potential? Americans and American businesses have about $16 trillion invested in the U.S. and about $12 trillion deposited in offshore financial centers, with the offshore portion growing $800 billion a year. Economists say a lot of that $12 trillion will repatriate very quickly. Congress asked Alan Greenspan, how long would it take under the fair tax to bring some of this money back into U.S. markets? Years or decades? His answer, months. In addition, more foreign investors will want to invest here. Now be sure to look at my other YouTube video that continues this topic called Fair Tax Questions and Advantages.